Consumer confidence is falling. More mass layoffs have been announced. Trump's tariffs between Canada and Mexico are going to go ahead. Stocks are falling and we've got new stagflationary risks. Ladies and gentlemen, there is so much happening in the economy and in the markets right now that's going to affect my life, is going to affect your life, our finances, and we need to understand what is happening right now, what's going to happen in the future so we can prepare. Welcome to the first no fluff, fast-paced economic report that you need to understand what's going to happen for your family's financial situation. So everyone, without further ado, let's get straight into the news, the facts, and the data. Well, first things first, look at this everyone. Recession fears rise as US consumer confidence falls, and it is falling to record lows. So US consumer confidence fell this month by the most since August 2021 on concerns about the outlook for the broader economy, adding to a growing stack of indicators that uncertainty over the President Donald Trump's policies has Americans increasingly worried about their economic future. The Conference Board gauge of confidence decreased 7 points in February to 98.3, marking the third straight decline, data released Tuesday showed. The figure was well below all estimates in a Bloomberg survey of economists, and stocks and bonds fell after the report. So we can see with these charts here, US consumer confidence drops on concerns about the economy. The consumer confidence index fell. Present situation index, that fell. Expectations index fell. And we can see inflation expectations is surging. Well, the drop in confidence was broad across age groups and incomes. Consumers were more pessimistic about current and future labor market conditions, as well as the outlook for incomes and business conditions. Perceptions of present and future financial situations worsened, and the share of respondents expecting a recession in the next year rose to a 9-month high. So this is not good, everyone, and this is what it's leading to. That pessimism has Americans cutting back their spending, according to a new study from Wells Fargo. More than half of consumers are delaying major life plans due to uncertainty over the economy and consequences of Trump tariff threats. Of those, about a third said they were putting off buying a home, while 1 in 6 has postponed education plans and 1 in 8 have pushed back retirement. But that's not all that's happening. We just got this new report from Starbucks that shows what's happening in the labor market. So look at this. Starbucks to lay off 1,100 employees this week as CEO aims to deliver on turnaround. In a letter obtained by Yahoo Finance sent to employees on Monday, Nicole shared that the company plans to eliminate 1,100 support roles and several hundred additional open and unfilled positions globally. The memo said employees will be notified by Tuesday, February 25th. Nicole said the layoffs are meant to simplify the company structure while removing layers and duplication and creating smaller, more nimble teams, aka they need more money and more cost cutting. He added, "Our intent is to operate more efficiently, increase accountability, reduce complexity, and drive better integration, all with the goal of being more focused and able to drive greater impact on our priorities." But what's really worrying consumers and consumers' expectations for inflation is what's going to happen with these tariffs. So Trump says tariffs on Canada and Mexico will go forward. President Trump said that sweeping US tariffs on imports from Canada and Mexico will go ahead when a month-long delay on the implementation expires next week. The tariffs are going forward on time, on schedule, Trump said, when asked if postponed tariffs would soon go back into effect. So next week, we are likely to see an announcement that these tariffs will go through, and either businesses are going to have to absorb these costs, which is going to affect their bottom line, or consumers are going to have to pay higher price. And in our next story, Elon Musk and Tesla is in a very bad situation. So look at this, everyone. Tesla's sales fall 45% across Europe as buyers respond to Musk's moves into politics. So at the same time, overall EV sales surged 37%, with rival car makers making strong gains in Germany and the UK. In the UK, Tesla trailed China's BYD for the first time, with sales falling nearly 8% in the market that grew 42%. Tesla is overhauling production lines for its top-selling Model Y SUV, while its CEO Elon Musk grows more politically divisive. And we can see here, Tesla is down nearly 37% from its all-time high in December last year. People are particularly skeptical of Tesla's driverless technology, predicting that its rollout in June 2025 will either be a failure or face significant delays due to fundamental flaws in its camera-only approach. He insists that without LiDAR and radar, Tesla's systems remains highly error-prone. Additionally, he criticizes the Optimus robot, arguing that it lags behind industry standards and is inferior even to robotics technology developed decades ago. More importantly, he points to the deterioration of Tesla's core automotive business, which accounted for nearly 90% of its revenue in the fourth quarter of 2024, as a sign of deeper troubles. He asserts that Tesla's brand is losing its appeal globally, with many consumers viewing its vehicles negatively. But what do all of you think? Let me know down below. Now, this leads us to our next story. The vibes on Wall Street are starting to sour. Just take a look at these charts below. So we first see defensive stocks take the lead. Shares of defensive stocks like healthcare and consumer staples have raced ahead in 2025 since the start of the year, and these two sectors have top performers on the S&P 500. And like I've been saying, the Magnificent Seven has been in a big bubble, which has created a lot of gains in the S&P 500, but now we're starting to see defensive stocks starting to race ahead. And we can see in this chart here, Magnificent Seven, the green line is falling while the other stocks are taking off. We're seeing demand for hedges soar. So the CBOE SKU index soars. Demand for protection against a stock market correction appears to be climbing, as we can see in this chart. Next, bonds are rallying as investors seek safety. So when bond yields rise, that's when you're going to see investors go into more risky assets like the Magnificent Seven. But when bond yields all of a sudden start tumbling, and people are going into gold, which is safe havens, well, then that's when you know people are a lot more pessimistic about the markets and the economy. Next, economic reports leave investors disappointed. So for the first time since September, the Citi US Economic Surprise Index has been consistently negative, and the gauge has issued negative readings over the past 4 days, as a disappointing reading on the US services sector activity was followed up on Tuesday with another disheartening decline in US consumer confidence. And we can see that in this chart here of Citi Economic Surprise Index, and it is sinking further. Our next chart here, gold is climbing and Bitcoin slides. So Bitcoin is a risk on asset. So when there's a lot of risk appetite in the markets, when people are feeling very bullish, they go all in on Bitcoin. But when people are very, very worried about the economy, when people are worried about how bubblish the markets are getting, well, then they go ahead and go into gold, as well as if they think their currency is going to be devalued further, which is happening. So put simply, people are adding protection. The stock market has been in a huge bubble. People are diversifying their assets. They're going into more safer assets as they know big things are coming. And so what is this all leading to, everyone? Stagflation. Because look at this next report here. Stagflation is a new threat to the stock market rally and what investors need to know. Put very, very simply, stagflation is when inflation stays high but economic growth falls. And what do we have right now? We have the CPI increasing. We have the economy, consumer sentiment. We're seeing layoffs. The economy is weakening. So we do have stagflation, not just happening in the US, but many countries around the world right now. And unfortunately for central banks, there's no simple cure for this. They can't lift interest rates to stop inflation because that will make the economic downturn even worse. And if they try to cut interest rates to try to boost the economy, well, then inflation is going to get worse. Put simply, all they have to do is ride this out. The economy has been artificially propped up for far too long. Governments have tried to kick the can down the road for far too long. And we need the free market. We need the market to really figure out what is fair value, what are productive assets, what are productive businesses. Stop bailing out the banks, stop bailing out big corporations, and let the market reset. But everyone, what do you think about all of this? This has been a No Fluff report. Thanks for watching. You're awesome. I'll see you all in the next video.